Clark, which was just announced last week together with Chevron. It's a shutter-style flow control valve that's able to get Class 6 bubble point and yet have the opportunity for a smaller footprint and potential for a piggable flow control valve. We're quite excited about this one and looking to take it downstream.
In terms of how we think about investing in the space, especially coming out of the downturn, there's a few current thematic areas of interest, as we like to call them. There's a very well-known trend in completion and drilling intensity. So what does that mean? It means that we're doing a lot more with more. So we are drilling longer laterals with tighter spacing, using a tremendous amount of proppant and chemicals to fracture wells. The drilling intensity, the equipment needed downhole tool-wise as part of the BHA, the drill bit, up through the rest of the BHA, so the durability of those components required for the intensity that is increased.
I think as you see analytical tools, for instance, coming in that have been established in defense and in pharma, we're invested in 908 devices, right? Looking at what they've been able to do. It's a mass spectrometer, which for anybody who's ever worked in a lab, right, you're thinking this gigantic thing. You can hold it in your hand. It basically looks like it's 2 or 3 times the size of a laptop, operates at 1 torr. Being able to put those type of analytical tools in pharma, in defense has been, very rapid. Watching that go.
There were 3 companies across all 3 funds that we combined to create scale through the downturn. So a middle market oilfield services private equity firm experiencing a downturn like what we just went through has to get pretty creative in terms of how it can defend and support its investments. In a upcycle, you can find opportunistic bolt-ons that you're willing to pay good value for to create that scale, but in a downturn, it's very hard. Dynacorp was a business based out of Canada that we invested in during the downturn that had a very interesting IP-protected sand filtration system. So if we think about the production of fluids via a separator as part of a production facility, the increase in proppant usage, and there's also natural geologic sands that exist. We're continuing to tear up production equipment on site. So they have a patent-protected cyclone and sand filtration system that helps mitigate that abrading agent coming out of the well. So a team that came out of Baker in their pipeline and process services division developed an innovative, what's called MFL ILI technology. So it's a smart pig, and it uses a very common form of inline inspection technology, which is magnetic flux leakage.
And you think of methane really as, there's hydrogen, right? It's got 4 molecules of hydrogen, 1 molecule of carbon. So recognizing, again, our broad scope of reducing emissions, improving efficiency, what if I said that I would, instead of burning methane, producing all that CO2 or converting it into chemical, let me find a way to basically extract the hydrogen, use that as my energy carrier for fuel cell vehicles and other applications. And then I have solid carbon, right? And there are many different forms of solid carbon. You've got carbon fibers, you've got nanotubes, you've got carbon black. A whole host of products can be obtained. The question, of course, is, it's a tremendous high temperature, a lot of energy involved in doing this. Can I do it in a way that's economical for both the hydrogen sector as well as the carbon sector? And when you compare it with some of the alternatives, it does seem that it's feasible. Another program that we had was natural gas for transportation. Again, we like to give our programs cute names, methane opportunities for vehicular energy. And again, a lot of this was focused around better ways to store natural gas on board. So folks may have heard of a company called Volute, which is based in the Bay Area. Came up with a neat way in which you could actually package and put natural gas into a container that could then go on board on a vessel or rather on a vehicle.
So Foghorn is an investment we made early last year, leading it together with Intervale Capital. It's an edge computing technology where you have a very small footprint client. So you're talking extremely small, able to sit on your PLC, SCADA, your security device, and run machine learning at that point. This avoids the need to send everything up to the cloud, because it's great if you send all your data to be learned on the machine in the cloud. The problem is when you get the bill for your communications. Taking the next step in digital, which in one branch might be not only what is pure digital capability, but in oil field where hardware tends to be so important, where how can you introduce analytics, how can you introduce capabilities to measure digitally what you haven't been able to measure before, and thereby drive greater efficiencies in your operations or greater knowledge about what's occurring. We think that digital physical match will become more and more important in the digitization of the industrial side. So rather than go and modularize your system, this proprietary set of connections and the design capabilities, both digital as well as physical in the fabrication facility and then in the deployment, leads to a faster construction time, a lower cost of design. So you're looking at increased construction speeds defined by lower man hours per ton on the order of 3 to 10x. If you're sitting in the middle of who knows where in Saudi Arabia, you can imagine why that might be useful. Cost of labor is low, cost of logistics is not. Neither is the cost of rework.
The digital oil field, as it's called, is real, and the need for it is tremendous, as was discussed. I think oil field service investors, like some of the E&P companies that are presented with new technologies, it's hard to really wrap your mind around how that can translate into a durable business in the oil field. So companies that say the industry as a whole, obviously it is a lot smaller than it was in 2014. In 2014, the market in aggregate was over 450 billion. Today it is at around 250 billion. Still a very large market with a very complex value chain. We study the universe of investable opportunities, and then we deploy efforts to identify actionable companies to invest in. We try to make thoughtful, flexible investments and avoid overpaying, of course. And really the mission is to help companies grow. In the middle market, a lot of times that means professionalizing a business. So you may have a talented management team with a high quality product or service, but they need assistance building their back office, for example, or pulling talent in, or finding an executive that has pulling power that can pull additional talent in. So we start with a strong foundation, a good team, a high quality product or service, and we inject capital to build that. You could invest in a management team that may be good but not great, but they had iron or equipment that was in demand, so it would be utilized. We're always looking for innovation in technology. Like that's a given. We love IP. The higher quality and better protected, the better. But that's hard to come by in the middle market private equity space. I think what we look for now are more so going concerns that have high quality management teams, that have some differentiation in terms of the product or service. But I think the days of commodity iron investing in the oil field services space is just a lot more challenged. The inefficiency with which we produce unconventional reserves or zones is incredible. I think it depends on the stat you look at, but it's 5 to 7% of the available resource is able to be produced from the technology that we deploy. So that each incremental improvement in that is a major or a factor of production increase that we would experience. So it was a vicious cycle. But I think the efficiency we saw was tremendous in terms of what one well could produce. So the lateral distances, the amount of sections, which then translated into the amount of horsepower needed, proppant required, chemicals, fluids, etc. Those efficiencies were real. So you had this inflection where the cost to produce a barrel of oil dramatically fell because the pricing costs fell, but then the efficiencies gained as the prices increased. You have an interesting inflection point that you need to sort of reevaluate coming out of a downturn. And we're still seeing depressed prices, but I think it's all about how efficient you can be providing the service.
Many of the programs end up developing, a small device that can be scaled rapidly. That you can produce multiple thousands of units, and it's easy enough to do that. I'll talk about small scale methanol, small scale GTL, small scale ammonia, I mean, those are potentially ways in which you may be able to address the issue of capital intensity.
Maybe the best way to put it is in private equity and middle market private equity, we make investments for a horizon of typically 3 to 7 years. So 3 to 5 is the sweet spot. Sometimes it can be shorter. We have had a number of successful exits leading up to the downturn. We tried to hold on what we could and did hold on to our companies through the downturn. And at this point, again, I think scale is a big part of the exit strategy for a firm like ours. Middle market gets paid often for creating scale. Of course, it's cash flow, EBITDA, and margins associated, durability of the business, differentiation, et cetera. But scale is what can help us a lot.
The reality is that in many cases we're investing in a significant syndicate. We have syndicated a great number of our investments. We have not funded further rounds because valuation got to a point where we thought our dollars were better spent in earlier rounds than in the latter ones.